welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Miami at Exchange, an ETF experience where we're meeting with the top thought leaders and innovators in the ETF space. Joining us for this segment, we have Bill Smalley, Executive Managing Director over at Virtus. We're going to take a look at non-traditional sources of income. Bill, it is great to see you on the ground again. Welcome to Trade Talks.
Jill, it is great to be here in person.
And we know interest rates are rising here, but we're still in a low yield environment. Give us a backdrop of what you're looking at with fixed income.
Yeah, so you're right to frame it that way. Everybody is talking about how to manage this rising rate, interest rate environment. But it's important context to note that we're coming off of historic lows. So yields are low in absolute terms, and they're actually negative in real terms. So the combination of rising rates and inflation and the interplay between the two makes for a challenging market environment, and we are here talking to investors about alternative sources of income to address both of those dynamics, which are, like I said, kind of working together.
And I want to hear about some of those funds, but I want to ask you first, how are advisors rethinking their fixed income strategies?
It's a really good question. I think there's a lot of uncertainty out there. We're hearing different things from different advisors on how they're trying to address this marketplace. It's very common to hear people looking to move to the short end of the duration curve. Bank loans, for example, an asset class that has been seeing some very significant inflows, tends to do well when interest rates are rising. So I think we're seeing a lot of people shortening up, but the problem with that is the yields are low. The shorter you go, you're less likely to be meeting your income needs, particularly as a retiree, for example.
And we're living longer too.
Yes,
so
exactly.
You have to think about the duration as well. Tell us about some of the solutions that Virtus is providing for income investors.
Yeah, well, I mentioned bank loans. We have a fantastic bank loan ETF, ticker SEIX. It's an actively managed bank loan fund and a real standout. It's actually something that we're talking about a lot at this very event. There are a couple other things that we think play well with bank loans. Preferred stocks, for example. We think they're a little cheap right now, so it's a good kind of relative value opportunity we see in preferred stocks. We also like securitized credit. It's we think an area of the market that most investors either don't touch or are underweight. And you could stick with high quality credit on the short end of the curve and get higher yields than you might from investment grade corporate bonds. So these kind of alternative solutions, I think investors are broadening the opportunity set to include some of these more niche income producing assets.
And as we think about, we know rates are going to continue to rise. Mm-hmm. Well, is this, I guess, a good time to get into these kinds of funds? Because they should do well when we have higher interest rates. Is that part of the thesis behind it?
We are counseling to diversify. So it's important to broaden the opportunity set, but you need to be looking at the risks associated with anything higher yielding. So to use an example, pairing bank loans, preferred stocks, utilities, for example, equity income. All of those react to interest rates differently. So if you're specifically trying to address interest rate volatility or interest rate uncertainty amid a consensus rising interest rate market, doing it in a diversified way, you can get higher than benchmark yields, certainly beyond the traditional 60-40 portfolio. And that's we're seeing interest in these kinds of asset classes that we've never seen before. So it's fascinating to have these conversations with investors who are thinking about this for the very first time. And maybe it's that inflation, dynamic, entering the picture now. We've been in a low rate environment for a long time. Now there are some new dimensions to the challenge.
It's interesting you say that because I feel all the conversations that we're having on Trade Talks, for the first time in a long time, active management and diversification seems to be such a big part of the narrative. Yes. Certainly active management, which was really not the case when we were in that steady environment, to your point.
Sure, and with these kinds of assets, high touch, active management from specialized managers with a long pedigree, long track record, and a pedigree in these areas, we think is crucial. Active management obviously is a rising thing in ETF land here. And I expect you'll see more products in these kinds of areas that will rely on active management. We're also seeing some, well-established asset managers entering the space, and I think the landscape is changing in real time here.
Yeah, well, it's exciting. The more active management, you get some really cool, innovative products that come along the way.
Especially in fixed income.
Yep. All right, Bill, appreciate the insight as always. Thanks for joining us on Trade Talks.
Thank you, Jill. Thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.